Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Whitestone REIT Quarterly Report. Whitestone REIT provides a range of businesses and services through its open-air retail centers in growing markets across the country. These include food services, restaurants and grocery stores, self-care services, health and fitness facilities, service-oriented businesses, financial institutions, and logistics providers, educational services, not specified but implied to be part of the community-focused approach, entertainment options. Not specified but likely to include various forms of leisure activities, these diverse offerings cater to the convenience needs of local communities, fostering strong connections between the company, its tenants, and the surrounding neighborhoods. Whitestone REIT's stock price dropped by -6.76% over the past year due to a combination of factors. The company's Cone 2025 earnings miss was a significant contributor, with EPS and revenue falling short of analyst expectations. Although Whitestone reported stronger than expected Q3 2025 earnings, concerns emerged about the quality of these results, which were flattered by a one-off gain. Analyst downgrades, including Weiss Ratings' downgrade from buy to hold, also negatively impacted investor sentiment. Additionally, the broader commercial real estate market faced headwinds in 2024 and 2025 due to higher interest rates and concerns about underlying real estate valuations. These factors collectively contributed to Whitestone REIT's stock price decline. The primary drivers of revenue growth or decline can be summarized into three key areas: operational performance, financial management, and strategic decisions. Revenue growth is primarily driven by operational performance, including a 19% increase in total lease value, a 6% decrease in square footage leased, and a high occupancy rate of 69%. Additionally, the company's ability to maintain or increase rental rates in submarkets and reduce bad debt adjustments has contributed to revenue growth. On the other hand, revenue decline is primarily driven by financial management issues, including bad debt adjustments and straight-line rent adjustments. The company has experienced significant decreases in revenue due to these factors, which have offset some of the gains from operational performance. Strategic decisions, such as acquisitions and dispositions, have also played a role in driving revenue growth or decline. While the company has made several strategic acquisitions, it has also disposed of certain properties, resulting in gains on sale that have contributed to revenue growth. Net income and profit margins. A changing trend. The financial summary reveals a mixed trend in net income and profit margins over the years. In 2021, net income was $114,219, but it increased by 8% to $123,111 in 2022. However, for the 9 months ended September 30, 2025, net income decreased by $28,000 compared to 2024. Profit margins also showed a significant increase, rising from 76.5% in 2021 to 83.4% in 2022, representing a 7% growth. The reason behind these changes is not explicitly stated, but it can be inferred that the company's financial performance improved in 2022 due to various factors such as cost-cutting measures or increased revenue. The trend suggests that net income and profit margins are subject to fluctuations over time, with 2022 being a notable exception where both metrics showed significant improvement. Further analysis is needed to understand the underlying reasons for these changes and their implications on the company's overall financial health. The company's financial performance indicates a strong ability to generate cash from its core business operations. With an operating cash flow of $34,907 million, the company demonstrates its capacity to produce significant revenue and manage its expenses effectively. Furthermore, the excess cash generated from operations amounts to approximately $14,098,000, which suggests that the company is not only generating positive cash flow, but also retaining a substantial portion of it for future growth or distribution to shareholders. This financial performance underscores the company's stability and potential for long-term success. The company's financial situation has undergone significant changes over the past year. Notably, its debt level has increased substantially, rising from $56.3 million in June 2024 to $441.1 million by September 2025. This increase is largely due to a new loan facility. In terms of interest expenses, the company's fixed interest rate has decreased from 6.23% in June 2024 to an unspecified rate for the term loan with swaps and 5.72% for the revolver by September 2025. The company has also entered into interest rate swaps to mitigate the impact of interest rate fluctuations on earnings and cash flows. Overall, these changes indicate a significant shift in the company's financial position, with increased debt levels and altered interest expenses. Management is optimistic about the company's outlook, citing several key strategies and expectations. The company expects a significant portion of unvested awards to vest over the next few months, resulting in a non-cash share-based compensation expense of $1 million in 2025 and subsequent years. In terms of revenue growth, management anticipates an increase in rental income year-over-year due to new property additions and rent increases on renewal leases. The company's focus is on portfolio-level performance and resource allocation, with net income attributable to Whitestone REIT as a key metric. To drive growth, the company plans to expand its gross leasable area, GLA, through strategic property acquisitions in high-growth markets that align with its community-centered properties strategy. Management also intends to continue investing in properties with potential for increasing value and diversify market risk by acquiring similar properties outside of core markets. In terms of liquidity, management believes cash flows from operations will provide adequate capital for working capital requirements, capital expenditures, acquisitions, and debt payments in the short term. Long-term liquidity needs will be met through a combination of net cash from operations, long-term indebtedness, sales of common shares, issuance of OP units, and other financing opportunities. Overall, management's strategy is focused on driving growth through strategic acquisitions, increasing rental income, and investing in properties with potential for value appreciation. The company has made several strategic moves through acquisitions and divestitures to shape its portfolio. Key acquisitions include the Village Shops at Dana Park and San Clemente, both acquired on May 5, 2025. Additionally, a redevelopment project was initiated as part of a new acquisitions portfolio. On the other hand, the company has also divested several assets. These include Providence, which was sold in December 2024 through a like-kind exchange. The Uptown Tower property was also sold on July 17, 2025. Furthermore, the investment in Pillarstone OP was reclassified as a receivable, and substantially all of this investment was redeemed by exercising notice of redemption on January 25, 2024. That concludes the financial summary for Whitestone REIT. Feel free to comment below, and I will be happy to answer them when possible.